Yesterday evening on the Lyft earnings conference call, CFO Aaron Brewer had to correct their profit margins, expected profit margins for 2024, when she corrected the initial figure of 500 basis points to 50 basis points. Now that's a huge difference. Now I thought on the day, trading day for Wednesday, the stock was going to decline. However, what we see is a gap higher, and we actually see a gap and go. So, despite the negative debacle bullet point, Lyft is still moving higher. Before we look at the analysis on the charts, let's actually get into some of the news. So, Lyft experienced a surge in its stock value, jumping over 60% following release of the optimistic profit and bookings forecasts on February 13th. That exceeded investor expectations. However, after the initial stock surge, Lyft faced a setback when it revealed a mistake in its margin projections during the earnings release, and shares lowered to around 17% gains later in the session. This misstated margin prediction, which Lyft attributed to clerical error, constitutes a black eye moment for Lyft. It's a debacle of epic proportions. Never seen an error like this in my almost 25 years on the street, Dan Ives, an analyst at Wedbush Securities, told Bloomberg. Notably, despite the downward revision, the stock has remained green as its earnings forecast showed that the ride-hailing company's efforts to enhance ridership and compete with industry giant Uber are showing promising results. It was also boosted by other positive predictions such as EBITDA, which was in the range between 50 and 55 million, surpassing analyst expectations of 49.5 million. Gross bookings for rides excluding tips were projected to be between 3.5 billion and 3.6 billion. So these are anticipated figures, forward guidance more or less. Lyft's outstanding fourth quarter performance demonstrates their team's incredible work to build a solid foundation for profitable growth. They have entered 2024 with a lot of momentum and a clear focus on operational excellence, which positions the company to drive meaningful margin expansion and their first full year of positive free cash flow. This is the CFO Aaron Brewer saying. All right, so all good news despite the bullet point debacle, and it kind of shows you what type of environment we're in. We're definitely in a risk on environment despite the stock market dropping, crashing yesterday. Now, a couple things to note. You have this massive support resistance band at $18. However, if you put some type of oscillator indicator down on your chart, you can see that we have positive divergence, meaning price was making lower lows, but the RSI was making higher lows. And then we had this bear flag in which it closed above the upper portion of the channel, and then we had a gap higher, and this was going back to December. Now here was another trade setup. If you missed that breakout, this was not a high probability setup. It's a B setup, more or less. This is what you had a rally, base and candle, and then rally out, but price never took out the band, resistance support band at 18. However, this level still worked out. Wouldn't have been something I would have taken, but again, it worked out. Price came back for weeks, kind of stayed in this weekly buyers level until earnings. Had the drop, only to move higher. And this green candle is as a result of today's session. If we go to the daily chart, you can see that green candle on the weekly chart encompasses the gap higher in the daily chart. The prices are off its highs for the day. However, not a bad opportunity to take some profits off the table. Again, this band is going to be resistance for price action moving forward. Thanks for watching. Subscribe. Please like the video.